right, what the heck just happened to the stock of SL Green Realty, the largest commercial real estate landlord in Manhattan, with interest in 53 New York City office buildings totaling over 30 million square feet? Now, this stock has been frustrating, basically flat over the past 12 months, and it only got worse last week when SL Green reported a seemingly strong quarter, and yet its share price got clobbered anyway. Before we get to this quarter, though, let's set the scene. Last year, the office REITs, they were on fire. This one nearly got back to the 2021 highs last November, but then it plunged from $82 and change at its peak down to just over $45 at its post-Liberation Day lows in April. Well, SL Green rebounded to over $60 as of today. It's still down 27% from its November highs and down nearly 6% from where it was trading a week ago. What went wrong here? Hey, look, this is an office real estate play, and anything real estate right now is hostage to interest rates. SL Green soared to an almost 3-year high last November, not long after the Fed started cutting rates. But the moment the Fed cut short rates, longer-term interest rates soared. And once the Fed paused its rate cuts last December, SL Green and the rest of the office REITs, they saw their stocks fall apart. After all, high rates make financing more expensive for these guys, and they also make SL Green's 5.1% yield look a little less enticing by comparison. Of course, last month's mayoral primary didn't help here either, did it? Remember, this is the largest commercial landlord in Manhattan, and last month, an avowed socialist, Zohrab Mamdani, won the Democratic primary in the New York City mayoral race. That gives him good odds of becoming mayor, even in this crazy four-way race. And hey, a lot of investors figured that a socialist, even a Democratic socialist, might be bad for business. I mean, structurally, they don't really make the best relationship. They don't get along with landlords. And that's why SL Green's stock fell 5.7% the next day. I don't want to dive too much into local politics, and you don't want me to either, especially because I don't think the mayor has the power to single-handedly crush the commercial real estate market. Let's just say you got to keep an eye on it. Still, if you were hoping SL Green could make a comeback after it reported last Wednesday after the close, those hopes were quickly dashed. When those headline numbers crossed the wire, the quarter, at first, it looked really good. SL Green seemed like it delivered a big beat. It's substantially higher than expected revenue, up almost 9% year over year. With funds from operations per share, that's the real estate investment trust equivalent of earnings, coming in at $1.63. Wall Street was only looking for $1.38. And SL Green flowed that beat through to its guidance, raising its full-year funds from operations forecast by 40 cents from its previous outlook. Also much better than what the analysts were expecting. Yet it didn't help. Stock fell about 4% last Thursday, another 1.8% on Friday before stabilizing this week. So what on earth went wrong here? Simple. The quarter really wasn't as strong as it looked. See, SL Green made a $130 million investment in a mortgage for a Fifth Avenue property last fall. And they were able to sell it in the second quarter for a $90 million profit. That worked out to roughly 60-cent benefit, which was offset by a smaller loss on the sale of their stake in a Madison Avenue building that worked out to be about 20-cent hit. Together, those transactions resulted in a 40-cent benefit that was included in the funds from operations result. Remember, that's exactly how much they raised the full-year forecast by. In fact, when you back out the 40-cent benefit, the quarter itself would have been a sizable miss. All right, there were some other things analysts quibbled with, including some mixed operating metrics. But the dismissal of the one-time benefit is the main reason why SL Green got no credit for its big beat last week. So I want to take this point head on. Let me say two things. First, I don't think it makes sense to write off that savvy trade SL Green made with its Fifth Avenue investment. I mean, that's part of the business, isn't it? SL Green's knowledge of the Manhattan real estate market and its ability to make smart bets on properties in its focus areas, it's a real positive. Frankly, look, in a way, it's what you buy the stock for. But second, even if you inclined to dismiss that one-time item, I'm not too torn up about the fact that the second quarter would have been a disappointment without it. As CFO Matt DeLiberto reminded us on the conference call, this is a lumpy business, which is why they try to track things on an annual basis rather than going quarter to quarter. Even if you back out the 40 cents, their full-year fund from operations forecast would simply be unchanged. At the same time, there was a lot to like from SL Green's quarter if you were willing to dig deeper. Leasing activity remains very strong. 46 Manhattan offices leases totaling over 540,000 square feet signed in the quarter, bringing the company's year-to-date total to over 1.1 million square feet. Do you know that puts the company ahead of its target of 2 million square feet leased this year? And Manager also said that they, quote, refilled the pipeline to over 1 million square feet for near-term execution, end quote. We also got some good color on the pipeline during the conference call, with management highlighting the diversity of the potential tenants in the pipeline across various industries, as well as the fact that they're doing a lot of mid-sized deals. That's positive, because it means SL Green isn't on the knife's edge with one or two major deals whose success or failure would make or break the company. This steady deal flow is much more attractive to me. Plus, the company seems like they're finding it easier to lease properties, at least based on the amount of free rent that it needs to give out when it signs new ones. This is a very telling metric, and it fell to 6.3 months in the quarter. That's down from an average of 11.3 months over the past year. It's the lowest level in 5 quarters. At the end of the second quarter, SL Green's same-store office occupancy was 91.4%. Company said it expects that number to get to 93.2% by year's end. So all seems well with SL Green's core business. Finally, I like SL Green's long-term opportunities. I'm not necessarily talking about the company's current effort to bring a casino to Times Square. Some of the management devoted a decent amount of time on the conference call. We don't know if they'll really win that business. I'm just talking structural factors here, like the fact that there's minimal new supply of office buildings in New York these days, and SL Green dominates in Class A office properties, which remains the strongest part of the market. So here's the bottom line. In the short term, SL Green stock will remain hostage to factors outside of the company's control, like the direction of interest rates. But after this quarter, I really believe that the core business is in good shape. The 5.1% dividend yield is safe, and the stock could be a winner once the Fed starts cutting rates again. John in South Carolina. John.
Booyah, Jim.
Booyah, John. What's up?
Oh, calling about REIT stocks, thinking about real estate with the supply constraints and, looking at smaller, more nimble groups like NetStreet versus the big guys like Realty Income.
Mm-hmm. So which one do you want me to opine on?
For a 26-year-old investor with a long horizon, just curious what your thoughts are on a more dividend-focused real estate play versus growth.
John, I got to tell you, I'm going to have to say no to Realty Income. That doesn't mean I don't like it. I like it a lot. You got to go for growth. Growth is the only safety. You should be looking for a nice return. I mean, I'm talking about stocks like Nvidia. You should be in Nvidia even right here. I really think that Realty Income is for people who are a little bit older. What can I say? Hey, it's good to be young. Nothing wrong with that. Let's go to Johnny in Alabama. Johnny.
Hey, Jim. Love the show.
Thank you. Thank you, Johnny.
MP Material, what do you think the long-term prospect of the stock is, considering the highly unusual government deal? I've heard the government gets half of everything above 170 million EBITDA.
But they've got tons of EBITDA. No, the stock has moved to 61. Now, I have done more work on it, and I really think that I was a little, I wasn't negative, but I think there's even more upside, and I think you're onto something really big. Okay, look, it will be hard for SL Green to go higher if interest rates stay elevated. That's what matters. But I think the core business, people are way too negative about it. A long-term outlook for the company still seems excellent. Now, much more mad money ahead, including my exclusive with elevator maker Otis. Now, that stock plummeted over 12% today. What the heck's going on? I'm going to get to the bottom of it with the CEO. Man, I learned early on in my career not to mess with parabolas. But I have a new thesis, and I think it's going to surprise you. And, of course, all your calls rapid fire tonight's edition of the Lightning Round. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.